Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, it's getting closer to the end of the year. We've got fewer and fewer podcasts left, so we're trying to cram them all in and make sure that we're still delivering on our promises.
This is true, although we are taking about 4 weeks off over the summer break, so our listeners are going to have to go back to the back catalogue and dig out the nuggets of gold in there to get them through, I think.
Yeah, and you're going to have to, go back just to see me and listen to my voice as well. So it's going to be a difficult period for everyone.
It's a win-win as well, right? Andrew, what are we talking to our listeners and our viewers about today?
Yeah, so today we're talking about something that, has been is kind of always in the news, but it's been relevant as of late, in particular. And what we're talking about is how to invest when markets are crashing. What do you do? What are some of the strategies? What are some of the things that you should be considering as markets are falling, in terms of putting your money towards investments?
Turn down the noise and don't look. Podcast over.
Done. See you later.
I'm gonna talk about Warren Buffett.
I was waiting for it, so we might as well just get it out of the way.
So one of his many famous quotes.
If you haven't heard it already, you've probably heard it maybe 15 times on the podcast.
We should hit him up to try and sponsor the podcast.
Sorry, I
is be greedy when others are fearful and be fearful when others are greedy. So if you apply that methodology to a crashing market, basically what he's saying is things are on discount or things are on special and you should be in an accumulation phase. Now, broad brush statement, obviously it depends on a hell of a lot of circumstances, which we're going to unpack shortly, but that's the quote from the great man.
Exactly right. And I was waiting for it. The moment that we decided on the topic for the podcast, I knew that there was definitely going to be at least one Warren Buffett quote in this podcast.
I'm going to look up his list of quotes, his famous quotes, and I reckon that I'm going to try and introduce one every podcast episode moving forward now. So
you should do that and just not tell us and see if we can pick out which how much knowledge is from Warren Buffett and how much knowledge is from Billy.
Billy's wisdom, huh? Yeah. Yep, that's it.
No, well, look, I mean, first point in call is if markets are crashing, absolutely, the first thing that you should be doing is looking to accumulate assets. Not the first thing that you should be doing, but one of the things that you should be considering is looking to accumulate assets. That's, investing 101. You buy, at the bottom of the market rather than at the top. But before you do that, before you even go down that, course of thinking and before you start to explore and unpack that, what you should really be doing is looking at your own personal financial situation. That is absolutely step number one. I've seen that happen before. Markets are crashing, people get excited, they get into investments, get into investment positions, and then are forced to have to sell them, before they would ordinarily like to, because they've overextended themselves or because their circumstances didn't allow for it, at the time. But you really need to consider what's your, capacity to earn income and likelihood that that's going to continue throughout, a volatile period. What's your risk tolerance? Where are all of your other assets positioned? I mean, before you consider investing, regardless of market circumstance, whether the market's up, down, level, you need to look at your own personal circumstance first.
Yeah, and I guess to extend on that just a little bit, the reason why you're doing that is sort of twofold from my perspective. One, it's making sure that you're financially sound to be able to make that investment. That's first and foremost, because you don't want to leave yourself short in other areas. But the second thing is kind of getting back to the psychology of investing, especially if you're in that point of the market where things are volatile. So it takes a lot of resolve to be able to stay the course. And, investing is as much about discipline as it is about emotion. So being in a position where you're comfortable enough with your circumstances, where you can say, okay, yes, I'm going to contribute a certain amount of money, whatever that may be, and going back to investing principles, needing to keep invested for a long period of time. If your circumstances, your personal circumstances are on shaky ground or they're not where they need to be, I always tend to see, and the experience that I've had when I'm talking to people about it is, no matter what decision they make, if their house isn't in order, no matter how good your investments are, you're always going to feel a little bit uneasy. So for me, it's kind of a little bit more of an extension of that, where there's kind of two things at play. But absolutely right, absolutely agree. It doesn't matter what you're doing from an investment perspective. Firstly, you need to get, I think, your house in order, because investing in those times represents great opportunity, but you need to line yourself up for it.
Yeah, absolutely. What's the next point, Bills? What should we also be doing when we're looking at a volatile periods in the market?
Once again, it comes back to what you're referring to earlier. If you're in the right position, don't sell.
Yeah.
That's
the hardest thing.
The opposite's actually, let me just caveat that a little bit by saying, if you've got good quality assets, don't sell. With the expectation that those assets are obviously going to recover. There's different types of asset classes, there's recession-proof industries, there's different assets that you can invest in that provide a different level of comfort during periods of high volatility. But first and foremost is don't sell, don't panic, and don't listen to the noise.
Yeah.
They're probably the key things that I've taken away from all of these.
It's a really difficult thing to do. I mean, naturally, I think as humans, when you look at something that's not doing what it's meant to be doing, when you're putting money, you're essentially doing a delayed gratification. You're putting money towards something in order to be able to realize a net greater benefit at a future point in time. And when that's not happening and it's going the other direction, your natural instinct is, I need to do something. And so sometimes staying the course, remaining invested, and knowing that this is temporary rather than permanent is the most difficult step of all, because I find when people are adding money into investments in a period of volatility, you understand that you're purchasing something at a discount, and so it's exciting and most people are motivated to do so. But when the recommendation is just don't do anything, stay where you are, it's a lot harder to grapple mentally, because you feel like you should be changing or doing something different because it's not going your way at that point in time. So staying the course is a massive one if you're invested in good quality assets, and if those assets are going to prevail at a future point in time.
Yeah, I think it's loss aversion as well too. I mean, that's the emotional trigger, that people are scared that their investment is going to go to zero. But I'll use an example that I've come across recently. We'll use, I don't know, maybe Commonwealth Bank, because I know it's trading, it's over $100, but let's just say $100 for the sake of the exercise. Yeah. If in 2 weeks' time, it looks attractive at $100, in 2 weeks' time it goes to $80, so you've taken, or there's a 20% discount, people may look at that and go, oh, that's scary, I'm not going to do it, or I had the $100, I'm going to sell it, whatever it may be, versus, say, a property that's worth $1 million, and then in a couple of weeks' time, market softened and you can get it for $800,000. In my mind and in my experience, people would rush out to buy that house because it's at a 20% discount at this point in time. But when you overlay that to something different, it's exactly the same thing mathematically, but it's just different when you apply it to a different asset class, how the thinking switches. Because I think with property, people would see that and go, wow, this is a $200,000 discount. Whereas if you look at it from, say, CBA, using that as an example, I think it invokes a different emotion. And rather than looking at the opportunity potentially and saying, hey, this represents a buying opportunity because it's cheaper, it's actually, well, hang on a sec, it's lost 20%. Where's it going to go? Yeah. Do I buy now? What does it look like? Yeah.
I think it's a combination of a couple of things. I mean, on one side of the equation, it's just the fascination that we Australians have with property, and that's why, a lot of the times property can be such a resilient asset class, because there's such a fascination with it in this country. But I think also, in addition to that, is CBA is valued, almost every minute of every day that it's trading, and so you're actually seeing the fluctuations. Now, property is going to fluctuate as well. It's going to fluctuate as an asset class, but you're not seeing those fluctuations. You're not seeing that tomorrow it's worth $10,000 more or less than what it was yesterday. And so because it's not valued every day, it's only valued at a point in time that you decide to sell it in, 5 or 10 years.
Yep.
You're not seeing that volatility, even though it is still happening. Because if you sell your property today versus in 2 weeks' time, you are going to get a different price. It's never going to happen exactly the same.
Yeah. Dollar cost averaging.
It's massive.
Really powerful strategy that we talk about adopting as part of a regular investment strategy anyway. I think the benefit of dollar cost averaging is probably enhanced in a downward market. So I think it's really relevant in this instance. And we might use a worked example of, say, Commonwealth Bank again, just because it's a nice round number of 100 and it's easy to calculate. But dollar cost averaging, before we get into that, Andrew, just run us through what that is.
Yep. So dollar cost averaging is quite simply just investing on a regular and systematic basis. So you're putting regular money into your investments over a period of time rather than trying to, time the market, dump everything in one lump sum and one go. So what you're doing is you're constantly purchasing assets, so you're averaging out your buy price. So, in your example, CBA is $100, it drops to $90, you're still investing a regular amount of whatever the number is, $100 a week. Drops to $80, you're still investing a regular amount of $100 per week. Drops to $70, you're investing on a regular basis so that you're constantly accumulating assets. And as the market is declining, you're accumulating assets at a cheaper and cheaper price, and you're taking the think work out of investing and removing emotion, really. Yeah,
so the concept behind it is if you've got good quality assets, obviously that's crucial, but believing in the asset and the underlying business that you're investing in and doing that on a regular basis to get the moving average of the asset price, as opposed to trying to pick times in the market when it represents good value. And the truth is, depending on the environment, we don't know whether it represents good value or not. It's most often it's a fact that it's after the case, and I think there's probably a Warren Buffett quote in there somewhere, but it's after the case. So the only thing that we can do on a consistent basis is pick the good quality assets and dollar cost average into them.
Yeah. And look, similar strategy that we deploy, but when clients are investing in any particular large lump sums of money, even during, whether it's good market environments, poor market environments, whatever it is, we're generally recommending that a client invest that periodically over time. So if, for instance, you're wanting to invest $100,000, rather than just putting all of that money into the market today, one strategy that you might deploy is put $20,000 every month over the course of the next 5 months, so that you're averaging your purchase price out, so that you're not dictated by the specific day that you put it into the market, but rather averaging out that purchase price.
Also, another one that I think is interesting, and we should touch on it as well too, is in times where markets are volatile, taking advantage of particular sectors that have been, and we'll use maybe the travel industry during COVID in terms of what happened there, but particular sectors that tend to get beaten up a fair bit, oversold, they're in the media. There's probably 2 I can think of in the travel sector that represents that quite well. But if we can identify those opportunities, that's moving away from, a different strategy where you're actually taking advantage of one particular sector as opposed to a diversified portfolio. But let's talk through that in terms of, what would be a good example of that that we've seen in the last couple of years.
Yeah, I think, look, the example that, everyone can kind of relate to is the impact of COVID on Flight Centre. Mm-hmm. Absolutely took a beating in terms of its share price. And a lot of intelligent investors looked at it and said, hey, this is a company that, people are still going to be flying. People are still going to be traveling post-COVID, even though, yes, they're going through a difficult time now. Their profits are going to be down. They're going to be laying off people, all of that stuff, which is bringing the share price down. It represented a good buying opportunity to purchase an asset at a heavily discounted price. And for the people that were smart enough to do so, it resulted in some, pretty hefty gains as things have recovered and, we're coming into a post-COVID world. So that's one example of investing in one specific company because the entire industry is going through, a massive turmoil. and that specific company is still, viable to continue into the future, viable to make a profit in the future. It's just that they're a victim of circumstance in essence.
Yeah, and look, once again, in hindsight, I guess this becomes obvious, but looking at something like a flight centre, the short-term thinking of COVID being, we're locked down, we can't travel. Okay, we understood that. In Victoria in particular, that was overly difficult because we were locked down for a long period of time. The short-term nature is no one's going to travel, and that was correct. But if you extend out and go, okay, we're going to navigate through this, there's a vaccination coming, we're going to get better with social distancing and masks and sanitisation and all of that, the amount of pent-up demand that people have will return to pre-COVID levels, but also the backlog about, hey, we've been locked up for a couple of years, we're going to go on an extra holiday this year to make up for lost time.
Yeah.
So, and it's difficult to do, and once again, you only do it in hindsight, I feel, but being able to sort of look a little bit further and say, hey, what's the longer term implications of this? And will this business not only be okay, because in most instances, businesses need to pivot to survive in those difficult times. They become more efficient, more profitable. So when they do come out of the back end, and I'm thinking of Qantas in particular, they do come back out of the back end a lot stronger.
Yeah.
So if you can sort of shift your thinking a little bit in terms of what's the short-term impact versus what's it going to look like in reality in the medium or longer term, I think that can definitely help from an investing perspective because it shifts your focus from all of the noise and all of the attention that's happening here to a longer-term horizon.
Yeah, exactly right. And it all comes down to, exactly what we spoke about at the very beginning is you need to know your personal circumstances, because if you're in that environment, even though the future is uncertain in terms of timing, because knowing that, the travel industry or a particular industry is going to recover in X amount of time versus Y amount of time is almost impossible. Were we going to be locked down and unable to travel for a year? Was that going to happen for 2 years, 3? No one is quite sure. But if you've got the certainty in your personal circumstances that you're not going to need the money, that you're going to be able to invest for the next, 5, 10 years, whatever that time period is, then you can ride that wave, and that you can, in essence, take advantage of that opportunity when it's presented.
Yeah, it comes back to your original point.
Yeah.
If you're on a solid foundation, it's a lot easier to navigate through this and see the opportunity and sort of play offense as opposed to playing defense, I think. And if you don't get that right, regardless of what the opportunity is or what the environment is, it's going to be difficult to navigate through it, no doubt.
Yeah, absolutely right.
What about avoiding speculation?
Yeah, I mean, look, I find in either circumstance, whether the market's booming or when the market is crashing, there tends to be, a whole heap of speculation in markets. That tends to be the periods of time where there's, massive talk, either on the downside or on the upside. So turning down the noise and making sure that you're basing your investment decisions on rationality rather than, hey, friend told me at a barbecue that, the market's crashing, but this company is pulling massive profits and you should invest in them because, they're going to do really well in X amount of years because cousins, friends, dogs, brothers. It's one of those things that, in periods of volatility, there's always a lot of talk.
Yep.
It happens all of the time, but I find that there's, a heightened amount of it. So making sure that you're making rational decisions based off knowledge, based off data, and based off, information rather than hearsay, she say, is absolutely important.
Yeah. And not wanting to sort of blow our own horn here, but having an investment strategy that you have completed and have it in mind before the event actually occurs, so then you don't actually have to make a decision around what you need to do at that point in time.
Yeah.
So it could be, getting the tip from somebody and then saying, okay, yeah, I'm going to consider it. And you get sort of caught up in this thing as opposed to a well-defined investment strategy and then saying, actually, you know what, I don't need to pay attention to that because I know what I'm doing and I'm just doing it and I know the results that it's going to get me, as opposed to getting sidetracked. And I've been in that position before where you do hear those hot tips and things. So you spend so much time, effort and energy pursuing those. I don't want to talk about my track record, but it's a waste of time, in my experience anyway. So you don't want to always try and chase the winners, so to speak. I think that's a futile exercise.
Exactly right.
Yep.
Another one that I think is important, in any market circumstance, but especially in this market circumstance, is diversification, Bills.
Yeah, I mean, look, pretty simple in terms of the investment approach that we take is, the saying. I don't think this is a Warren Buffett one, but not putting all of your eggs.
Amiridis one.
Not putting all of your eggs in one basket. And the idea is that different asset classes will move differently in different market cycles. So the idea is to spread your money, your investments across a range of different asset classes to get exposure to different things. And the theory is that when one goes up, the other one may not perform as well and vice versa. But the idea is across the board, you're getting a consistent rate of return across all of those asset classes whilst trying to minimize the risk of being exposed to just one particular asset class. That's pretty much it.
Yeah, exactly right. So, one of the things that can be almost impossible, and if not very, very difficult to do, is predict what asset class will outperform another asset class. So if everything is down, which asset is going to perform better? Who knows, as recovery and things bounce back. And so one method is diversify your investments. Have your eggs in multiple baskets so that you're capitalizing on that, irrespective of what actually does well.
Yep. What about managing tax issues when it comes to things like selling investments and stuff like that? Yeah.
Really, really common scenario that we, and it's just, I think, also nature of our profession and who we're talking to and the clients that we deal with, that a common situation that we find ourselves in is that a client has purchased a particular asset. Now, it's still a good quality asset, but it may not be the best asset that they should be holding. Now, the recommendation is still to continue holding that particular asset because there's a large capital gains tax implication. Yeah. So because of that fact, we don't, or the capital gains tax that the client would pay would outstrip the benefit of shifting that position and moving into an alternative asset. So under normal circumstances, it's a recommendation to continue holding that asset. When markets decline, what will happen is that asset will also decline in value, and so the capital gains implications are very minimal, or much more minimal than what they were previously.
Yep.
So it's a good opportunity to examine your portfolio, examine your asset holdings, and say, hey, maybe it's a good time to sell this asset because I'm not going to be paying such a large capital gain, and shift that into the other asset or the other assets that I would have liked to be in previously but couldn't because I had a large capital gains implication previously.
Yeah.
So it's a good time to pull out the underperformers in the portfolio that have a large CGT implication.
Yeah, a little bit more complex in terms of what we're talking about, but a really good opportunity to use that type of environment to sort of reshape your portfolio and maybe do a little bit of housekeeping and a little bit of maintenance to clean it up.
Yeah.
But once again, the taxation issue is a huge consideration. We've spoken to people before where they've had, these really well-performing stocks, but bought them a long, long time ago. They're still great performing stocks because the price that they bought them at back in the day was fantastic. And there's probably a better alternative at the moment, but the truth is we just can't sell them because the capital gain is so high that it just makes no sense to do that.
Yeah.
So in that instance, it's a challenge, but what you're talking about, if you can do that periodically, you need to obviously keep in mind the tax implications of any changes that you make into your portfolio as well.
Absolutely.
Yeah.
Bills, I think that rounds it off quite nicely in terms of what you should be doing and how you can be investing throughout periods of market crashes and volatility.
Yeah, so hopefully to our listeners and to our viewers, you've got a fair bit out of that. As always, if you want any further information or want to have a chat about your circumstances, feel free to reach out. We'd always be happy to have a chat and grab a coffee.
Look forward to catching you on the next podcast.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.